When I was 27, I watched a friend double his money in 6 months trading some hot tech stock. I felt like an idiot. I was working 50-hour weeks, saving every penny, and here he was turning a quick profit while bragging about buying a Tesla. I almost jumped in. Almost. But here's the thing. 2 years later, his account was nearly wiped out. That's when I learned something that changed my life. The fastest way to look rich is to chase hype, but the slow, boring way is how you actually stay rich. And here's the crazy part. With the right investments, boring can still be mind-blowing. Because if you took $100,000 not into risky bets, but into 5 carefully chosen Charles Schwab index funds, history says that money could grow into over $3.5 million, while paying you more every month than most Americans earn at their jobs. I'm Mark, this is Dividend Hustle, and today I'm going to walk you through those 5 funds, how they work, and why one of them has the potential to turn your portfolio into a cash machine, paying $20,000 plus a month for life. By the end, you'll see exactly why I believe this approach can buy you freedom, and why most people will miss it completely. Why this matters. Here's the uncomfortable truth. Most people aren't going to retire with enough money to maintain their lifestyle. Not because they didn't work hard, but because they played the wrong game. They chased the wrong opportunities, or they let fear and confusion keep them from investing at all. The result? Decades of work, and yet they're still dependent on a paycheck at 65. But it doesn't have to be that way. If you understand compounding, and you're willing to commit to it, you can flip the script completely. This is about taking control of your financial trajectory so that time starts working for you, not against you. Every year you wait is a year of compound growth you lose forever. The beauty here is that we're not talking about complex hedge fund strategies or insider access to deals. We're talking about a system anyone can follow, one that has built fortunes for ordinary Americans who simply started, stayed consistent, and let their money work for decades. Why Charles Schwab? When you're choosing where to invest for the next 20 or 30 years, trust and cost matter more than anything else. Charles Schwab has built its reputation over decades as one of the most reliable, transparent, and cost-efficient investment platforms in the world. Here's why that matters. Every fraction of a percent you save on fees stays in your account, compounding year after year. Over decades, those savings can be worth hundreds of thousands of dollars. Schwab's index funds have some of the lowest expense ratios you'll find anywhere, often a fraction of what other firms charge. No hidden loads, no commissions, just clean, low-cost access to the markets. And it's not just about saving money. Schwab's funds are built for broad diversification across sectors, countries, and market caps, and they follow transparent, rules-based strategies. That means you're not relying on the mood swings of a single manager. You're buying into a process that has worked through recessions, booms, and everything in between. Whether you're starting with $500 or $500,000, Schwab gives you the same low-cost access to the same powerful tools. And that's rare in the financial world. How we pick these 5 funds. With hundreds of index funds out there, I didn't just grab the ones with the flashiest returns from last year. That's a rookie mistake. Instead, I looked at 3 key things. First, dividend history. I wanted funds that don't just pay dividends, but have a track record of growing those payouts year after year. Because in the long run, rising income can be just as valuable as price growth. Second, total return. That means looking at both share price appreciation and reinvested dividends over the past decade or more. This filters out funds that look good in the short term but can't sustain performance. Third, structure. Is the fund market cap weighted or fundamentally weighted? Does it rebalance automatically? These details might sound small, but they tell you a lot about how the fund will behave in different market conditions. I also made sure we weren't limited to just U.S. stocks. The portfolio includes both domestic and international exposure, plus one fund designed to automatically shift from growth to stability as you get closer to retirement. Together, they create a balance of growth, income, and resilience, without the need to constantly trade or time the market. Fund number 5, Schwab International Index Fund, SWISX. Let's start outside the U.S. because too many American investors make the mistake of keeping all their money at home. SWISX is like a passport for your portfolio. It instantly spreads your investment across more than 700 companies from developed markets like Europe, Japan, and Australia. Why does that matter? Because when the U.S. is going through a slowdown, parts of the world might be booming. SWISX owns a balanced mix across sectors, financials, industrials, healthcare, tech, so no single industry dominates. The top holdings are global heavyweights like Nestlé, ASML, and SAP, but none of them make up more than about 2% of the fund. That means no single stock can sink your portfolio. Its expense ratio? A rock-bottom 0.06%. Over the past decade, it's delivered steady, reliable returns, with a dividend yield that's comfortably higher than the S&P 500. If you put $100,000 into SWISX and let it compound for 30 years based on historical averages, you could be looking at over $720,000 in value and more than $22,000 a year in dividend income before you even touch the principal. This is the sleep well at night part of the portfolio. Steady, globally diversified, and built for the long haul. Fund number 4, Schwab. Fundamental International Equity Index Fund, SFNNX. Now let's add a twist. SFNNX doesn't just pick stocks based on their size, it weights them based on real business fundamentals, things like revenue, dividends, and cash flow. That means when a company's stock price gets overhyped compared to its actual financial strength, the fund trims it back. And when a solid business starts to improve, it gets a bigger slice. It holds nearly 1,000 companies across developed countries outside the US, with no single stock taking more than 1% of the portfolio. You'll see names like Toyota, Shell, and Samsung, but you'll also see a healthy mix of consumer, industrial, and financial companies that have stood the test of time. Dividend yield? Around 2.9% with a decade of consistent growth. Combine that with steady share price appreciation, and the numbers get interesting. That same $100,000 investment, left untouched for 30 years, could grow to over $900,000, throwing off more than $32,000 a year in dividends. SFNNX adds a value tilt to your international exposure, helping balance out the more growth-heavy U.S. holdings we'll get to next. Fund number 3, Schwab Total Stock Market Index Fund, SWTSX. Now we come home. But we don't just go big cap. SWTSX gives you the entire U.S. stock market in one fund. Large caps, mid caps, small caps, all of it. If it's publicly traded in America, it's probably in here. Tech is the largest slice, but you also get meaningful exposure to financials, consumer goods, healthcare, energy, and more. Yes, it holds the big names like Apple, Microsoft, and Nvidia, but it also holds thousands of smaller companies that could be tomorrow's leaders. Expense ratio? Just 0.03%. That's practically free. And here's where it shines. Over the past 30 years, a portfolio of U.S. stocks like this has averaged double-digit annual returns. Put $100,000 into SWTSX and let history repeat itself. And in 30 years, you could be looking at over $2.7 million, with a steady stream of dividends on top. SWTSX is the core engine in this lineup. Massive diversification, ultra-low cost, and historically strong performance that has outpaced inflation by a wide margin. Fund number 2, Schwab S&P 500 Index Fund, that's SWPPX. If SWTSX is the engine, SWPPX is the turbocharger. This fund focuses on the 500 largest publicly traded companies in America, the blue-chip giants that drive the U.S. economy. Think Apple, Microsoft, Amazon, Nvidia, and Berkshire Hathaway. These are companies with global reach, deep cash reserves, and the ability to weather storms. SWPPX has one of the lowest expense ratios you'll find, just 0.02%, and it's been compounding wealth for investors since the late 90s. Over the past decade, the S&P 500 has averaged returns north of 11% annually, and SWPPX has tracked it nearly perfectly. That means $100,000 invested here, untouched for 30 years, could grow to over $3 million. Most of that comes from share price growth, but the dividends, which have been growing for decades, add another layer of wealth and income. By year 30, you could be looking at more than $40,000 a year in dividend income alone, and you'd still own a portfolio of the most dominant companies in the world. Fund number 1, Schwab Target 2045 Index Fund, SWYHX. And now, the one that could take the crown. SWYHX is a set-it-and-forget-it fund, built for people aiming to retire around 2045. But here's why it's powerful. Right now, it's heavily tilted toward growth assets like US and international stocks. But as the years pass, it automatically shifts toward more conservative, income-focused investments. You don't have to rebalance, you don't have to time the market, it's all done for you. SWIHX invests across multiple asset classes, including large cap, small caps, emerging markets, bonds, and even real estate, giving you broad diversification without the hassle of managing multiple funds yourself. Over the past decade, it's delivered strong growth, while also boosting its dividend payouts at an impressive pace. Run the numbers, and a $100,000 investment here could grow to about $3.57 million in 30 years. And by then, it could be paying over $20,000 a month in dividends. That's a full-time income without touching the principal. This is the definition of turning your portfolio into a self-sustaining cash machine. Key takeaways and action plan. Here's what this all means. Diversification matters, not just across companies, but across countries, sectors, and strategies. Low fees are a silent superpower. The less you pay, the more you keep compounding. Dividends aren't just extra cash. They're fuel for long-term growth when reinvested. Time in the market beats timing the market. Every year you delay is a year of compounding lost. Your action plan is simple. Pick a mix of funds that match your goals and risk tolerance. Automate your contributions. Even small amounts add up massively over decades. Reinvest dividends until you're ready to live off them. Stay consistent. Market dips aren't a sign to run. They're an opportunity to buy at a discount. If you're 25, 35, or even 45 right now, you still have time to make this work. But here's the thing. Your future self will thank you for the decisions you make today, or regret the ones you didn't. Every millionaire you admire built their wealth with the same tool you have access to right now. Time. You don't have to be a Wall Street insider. You don't need a six-figure salary. What you need is a plan, the discipline to stick to it, and the patience to let compounding do its job. A decade from now, you could look back and see the moment you decided to start as the turning point. The day you stopped hoping for financial freedom and started building it. This is Dividend Hustle. I'm Mark. Let's make sure your money works as hard as you do.